Well, good morning. This is Michael Douville, and we are in beautiful Phoenix, Arizona. This is another Creating Wealth production. Tatum and I are in the studios, and of course, questions are certainly welcome. So if you've come onto the webinar, there is a box on the top of the webinar for questions, and Tatum will monitor that, and you are welcome to send your questions. And if you do have a question, Tatum will alert me. Now, I'm going to apologize in the beginning because this is going to have a lot of graphs and some charts. This is kind of an intense presentation today because I'm going to talk about some of the economic factors that are in play today, and we're going to need some charts. So we will be making the YouTube available later this afternoon. You're welcome to the PDF and you're welcome to the slides. So just let us know. So let me move on with this. As you know, I've talked to Charles Nenner for many, many years. I've interviewed him many, many times. In speaking with Charles Nenner, Charles always says on his charts, I can see what is going to happen, not necessarily why. So today we are going to talk about the why and to see what possibly can happen. Now, this is part of my timing model. Now, the timing model has been extremely accurate. And as you can see right here, this is 2018. If you follow my work, I told my listeners and my clients that we're going to be starting into a correction. That correction started, and the forecasted was for the fourth quarter of 2019 or the first quarter of 2020. You can see it ended in the fourth quarter of 2019. Now, I interviewed Charles Nenner last year, and I was telling him I'm having trouble with my charts. He said, well, I don't have a bounce in the housing market until late of 2020. And what I was looking at was a spike, which is kind of an unusual pattern, but that's what happened in 1980 and 82. We had a double correction, but it is a correction in an ongoing bull market. So it just adds risk. So this is kind of a stylized version of the timing model. We are here in this mid-cycle dip, and that mid-cycle dip is going to last probably another 18 to 24 months. Now, in the other charts I've used, you can see the double dip. This is just a little more graphic. This is a little more fun chart. But coming soon is this right here. We are going to get the boom phase. If you are lucky, this comes into your lifetimes 2 or 3 times in your lifetime. This is when fortunes are made. This is when things really, really explode. And we're coming into this. We're here in a little bit of a recession. And right here, we're going to be going to the boom phase. Now, we're going to talk about the whys. There is no stopping the market forces that are coming. They are coming and coming hard. So we've been talking about the demographics. We've been talking about the baby boomers, the Californians. We've been talking about the people coming from Texas and the Midwest. That's been going on for 40 years. Now we're going to talk about some of the economics that are going on. So this is where it's going to get a little more intense. I want to tell you that there's still risk in the marketplace. The economy has not bottomed. So the U.S. economy is a service sector economy where 70% of us work in a service sector. We are no longer into manufacturing and industrial. We're more of a service, and that portion of the economy was devastated in this downturn, and there are lots and lots of people that will never come back to the same job they had. There's a lot of companies that will never reopen. A lot of businesses never going to reopen again. So I brought this up. This is kind of a very illustrative photograph. I want to tell you that the stock market does not represent the real economy. The stock market has done very, very well. The economy is still bruised and battered and badly beaten. But I'm going to tell you, this is just an aside, that in 2001 and in 2009, the stock market rallied to within all-time highs. It came back looking like it was over, and this is going to be a short and very quick stock market problem, and then it plunged. So I'm telling you that there is still risk in the marketplace. I know that the stock market looks very, very good, but the economy has not started to recover. We're still looking for what you call green shoots on this. So I'm looking for that virtuous cycle where we start to see things start to snowball on top of each other. Jobs start opening, and once the jobs open, they start supporting another job, and then those jobs start ordering more, people start buying more, confidence comes back into the marketplace. That's called a virtuous cycle. I have not seen that yet, but it is coming. And this is, as we've talked before, this is going to be a very vicious, very brutal recession, but I believe it's going to be a short-lived recession. And I don't really think that it's quite over with yet. I cannot imagine it really bottoming until probably maybe August or September of this year. And the stock market will lead it forward, but I think you just need to be very, very careful. Talk to your financial planners if you're entering into the stock market for sure. So let's talk about some of the economics of this. Now, I'm going to tell you that the economy is liquidity driven. You've noticed that in the past economy, right here in 2014, if you read my book, you'll see that 2014, we were starting to go into recession. The economy was really, really slowing down dramatically. That's when QE3 was born. $3.5 trillion was poured into the economy. Starting here, economy still kept going down and down and down, and then bottomed in 2015, and then it went off up until 2020. That was $3.5 trillion. Here in 2015, the Federal Reserve was putting in $40 billion a month in support and liquidity to the economy. This is just a little more of a chart. You can see this actually illustrates it even better because this is part of the case freight index, showing you can really see how shipping around the country, and of course when shipping starts to slow down, that means that the economy and merchandise is not being sent around the country, around the world, and you can see it was a pretty severe slowdown. The economy started to recover. We went into the election, we got into here, and President Trump did a tax change and put another $1.5 trillion into the economy, and you can see the economy popped. Now, once this liquidity is put into the economy, it does not last for all that long. So you do get a really big pop, but it kind of wears itself off. It's kind of like getting an injection, and the injection eventually wears out. And then you can see coming down into 2019, this is when I was starting to worry. You can see 2018, and you see 2019, things are starting to slow, and we went right into recession. My timing model showed all these things if you follow the work. Now, here's what I want you to understand is that the Federal Reserve has added $3.5 trillion worth of liquidity in the last 10 weeks. Keep in mind that in 2015, it took 2 years to add $3.5 trillion worth of liquidity. They did that in 10 weeks. On top of the Federal Reserve, the Treasury has added another $3 trillion in liquidity and they're looking to do more. So in the last 10 weeks, we've had $6.5 trillion of liquidity put into the marketplace, and that is going to show up. So we're going to have almost $7 trillion, almost double what they had in 2015. There's going to be a time lag, but it's going to show up and it's going to come over here, and it's going to be an explosive. So anyone who's holding assets, this is going to affect all assets. Now, of course, the stock market is feeling it already. The stock market is an extremely liquid marketplace, and it's already. So the stimulus goes into the economy, and it comes right out into the stock market. Now, real estate is a huge lag. Real estate, we won't see that for probably another 18 to 24 months. But I want you to understand, my timing model shows that the economy doesn't start and the housing prices don't really start moving for 18 to 24 months. They coincide exactly with the liquidity that's being put into the market right now. We saw that 2 and 3 and 4 years ago, and now we're seeing why that's going to happen. It's very, very uncanny, but we saw that really almost 6 years ago. We could see the big pop coming, and here's an enormous liquidity. Now, anyone that's in front of those assets is going to do exceptionally well. So the train is starting to leave the station. It's still standing still, but it's getting ready to go. So once it starts to go, it's going to really start moving. So those that are on the train are going to do exceptionally well. So here's one of my sayings that I love is ka-ching. So the liquidity lag is coming. It's 18 to 24 months away, and growth is going to be explosive. You are all going to make fortunes. Now, one of the other things that I'm seeing, and when I talk about risk, that in May of 2020, the International Monetary Fund, the IMF, has over 100 sovereign nations asking for money. 100 sovereign nations can't pay their bills. They're asking for the IMF to come in and bring in money. Now, I'm going to tell you that puts risk into the marketplace, because if you're into any kind of sovereign debt, if you've got Spanish debt, Italian debt, Indonesian debt, these things are probably at risk, and you need to really talk to your financial planner to see if this is something that you should really keep in your portfolio or sell. Because if they start to default, that's going to change a lot of the economics of the world. It will drive a lot of people into the US dollar, because it will be the only safe haven in the country, which goes right into the US dollar is also cycling. It's going right into our timing model. You can see the peaks, 1980, 2000, and we're peaking. Now, in speaking with Charles Nenner, he thinks we're going to get up around 112. I talked with Walter Zimmerman. He thought we're going to go north of 103. We got to 1028 just about 6 or 8 weeks ago. But he thinks that there is a possibility if we get turmoil in the market. Keep in mind, the IMF is talking to 100 nations that can't pay their bills and may default. That would be called turmoil in the world. If we get turmoil in the world, the US dollar could go to 120, which would be almost right here. And 120 in the world for a US dollar is turmoil in the world. There's lots of problems. But keep in mind that when the dollar peaks, it's called a peak. That means it stopped going up and it starts coming down. When you start seeing things coming down, commodities go up, because everything in the world is expressed in US dollars. And you can see as the US dollar starts getting strong, look what happens to commodities. They start going down. That's when you start seeing oil and copper. Copper's down really severely. Aluminum, iron ore, asphalt, concrete. What do we make out of those products? In my business, we make single family homes and real estate out of all that product. And I'm going to tell you, if lumber starts going up, and if we start seeing oil, which is going to drive asphalt and roofing supplies, if you start seeing aluminum going up and copper going up, then all the basic commodities that we build homes out of are going to go up. And that's going to be also driven by the fact that you have A, demand, and two, a declining dollar. Because once the dollar peaks, which is coming in the cycle again, once it peaks, then everything in the world is expressed in dollars. That makes in dollars. As the dollar goes down, means everything starts coming up for us that buy everything in dollars. So I just looked at this last week. Copper bottomed in 2008 at $1.37, in 2009 at $1.94, and just last week it was at $2.10. So we're pretty doggone close to a bottom, probably. Now, could it go down to 194, or could it go down more? Of course, if we get turmoil in the world and the US dollar goes up another 10 or 20%, you're going to see copper go down severely. But once it bottoms, it starts coming up. That is called inflation. And of course, you're going to have inflation all across the world. So this is what happens in 12 to 24 months. I'm telling you, you're going to start seeing prices go up in grains. You're going to start seeing prices go up in oil. All the precious metals will start going up. You're going to start seeing iron ore go up. These are all commodities that are tied to the US dollar. Now, here's the wild card I want to talk about. Last week, the interest rates broke their trend line. Now, they broke the trend line at a very, very low amount. It went up to under 1%. It broke into the 0.9s, but that broke trend line. And of course, once it breaks trend line, it's telling us that the interest rates want to go higher. So if they want to go higher, that's going to throw a little bit of a monkey wrench into some of our pricing. But keep in mind, we could very well have a bifurcated marketplace. If we have a kind of a difficult economy, which is what I see, we have 70% of the service industry is really in trouble. We have 43 million Americans still out of work. means that the economy is pretty soft. So those companies, you start to see Ford, you start seeing General Motors, you start seeing General Electric, they're having trouble and they're paying more. They're going into junk status. However, you start seeing the absolute best bonds in the world, which are the U.S. Treasuries, they are going lower and lower and lower. So you could have what they call a bifurcated marketplace. Those that are supported by the government and those that are not. Those that are supported by the government could push these interest rates down and push them down very, very hard. Now, keep in mind, most of the housing that we are in is supported by governments. They're sold into mortgage-backed securities, and the Federal Reserve is supporting them. So if they're coming in supporting the mortgage-backed securities, we're going to see interest rates stay stable at this rate or maybe even go lower. Keep in mind, in Europe, interest rates are negative. In the Netherlands, you can get a 20-year fixed rate mortgage for 0.8%. That's right, under 1% for 20-year mortgage. Now, if that's the case, if that transpires, and I'm going to tell you, the government has so much debt they cannot allow these interest rates to go up. And if they push these interest rates down, you're going to see home prices skyrocket. Because if you think about what your payment is going to be, everybody is payment sensitive. So if you can buy more house for less money, people will do that. So all these homes that you see for $250, if rates come down to 1 or 1.5%, they're going to go to $400,000. They're going to go to $500,000. If they go even lower than that, you're going to see homes just skyrocket. So you have three economic trends coming. You've got the U.S. dollar that seems like it's topping. You've got a historic liquidity coming into the marketplace, and you may very well have the government supporting negative interest rates or very, very, very low interest rates to keep the economy. Now, keep in mind, we actually went negative for almost a week on the Treasury bills. They were actually below zero, just minor. These were the 30 and 60 and 90-day bills, but they did go negative. So if we run into turmoil, and keep in mind, we have not come out of this recession yet, we could actually see interest rates go severely low. But I'm going to tell you, if you are on an adjustable rate mortgage, you need to talk to your financial professional. If you need to talk to your mortgage broker and get into a fixed rate product for yourself, because interest rates are wanting to go up. And of course, we're in an illiquid asset. Most of the time we look at things, we're going to hold these for 4 or 5 years, 10 years, 30 years. So we wanted some certainty in our lives. We want to go fixed rate if we possibly can. Now, Rabobank is forecasting Fed fund rates will be 0 by 2020. This is also supporting the fact that I think that we're going to have the Federal Reserve and the Treasury really supporting mortgage-backed securities, which is our industry. But Rabobank has the economy really, really soft and 0 by December of 2020. So interest rates still heading down by Rabobank. And you all know that as interest rates go down, they're going to result in much, much higher prices. In Europe, you can't hardly find a house for less than $1 million. Prices can go considerably higher, which is on our charts. So here it is. This is just stylized. I'm going to tell you, we're here. We've come down. This is May. We've come down into 2019, December, the fourth quarter of 2019. We're coming back up. And we're coming back down. We're probably going to have a small correction. Depending if you're in one of the 6 great markets in the United States, you probably are not going to have anywhere near the kind of problems that you're going to have elsewhere, particularly as the economy starts to open up. People are going to want to go back to work, but keep in mind it's going to take a little bit of time. Those people that have been out of work are going to have income gaps, and they're going to have employment gaps for qualifying. So that means a lot of people who would normally have qualified probably will be not. They're going to make great tenants, however. So in my business, that just gives us another pool of tenants that are going to be just great for our business. So those that are able to do this, here's an opportunity staring you in the face. This is for you to do. We are going to get through this. We're going to come back, and then we're going to come back up this chart and up around here, 2023, 2024. This is going to be like 2005 on steroids. The real estate business is going to explode. The economy is going to be explosive. Everybody's going to be working. Things are going to be absolutely outstanding. I know it's hard to see right at the moment, but that is what's going to happen. So cycle events are coming together like the perfect storm. This is your opportunity to do that. Now, we're not quite to that perfect inflection point that we want to start buying, but you certainly want to get ready for it. Get your bills under control. Get your payments under control. Go talk to a financial professional. Get a mortgage. Get qualified. Get pre-qualified. Start looking. Get your down payments put together. If you want to talk to me, you're welcome to come in. We've got people here that are more than happy to talk to you, but you have an opportunity that only comes 2 or 3 times in your lifetime, staring you in the face. This is your time to do this. It's coming, and it's coming quick. So get ready. In the next 18 to 24 months, things are going to be absolutely incredible. The economy will be booming. All asset classes. The stock market probably going to go to much, much higher levels from where it is. Also an asset class. You're going to start seeing housing, stock market, precious metals, all these things should be going good. Talk to your financial professional, find out what's prudent for you, build a plan. Interest rates may very well go down to almost next to nothing. We'll have to keep our eyes on that. That's kind of a wild card. But everything is pointing in our timing model that we're looking for much, much higher prices coming. So we're going to have a workshop. We're going to try and do this for you. Now, it's coming. We're all coming out of this lockdown. We're going to have a workshop. It's going to be coming. We'll sit down. It's going to be called Zero to Wealth. It's going to take someone that has nothing and try and figure out what's the best plan, some strategies for you to start getting onto the train and start doing this. You're welcome to talk to me at a confidential consultation. You know, I'm in my Scottsdale office most of the time. I'm here in the corporate office. You're welcome to call. You're welcome to look at my book. If you read my book, it's on Amazon. It's all across the world. You're welcome to look at this anywhere in the world. It's on e-sales as well. This will give you some basic concepts. Look, and you can go to the library. There's like 100 of these books that you can borrow. They all have the same concept. We want you to start buying properties. We want you to start borrowing some money, and we need to borrow it prudently to make sure that the asset works. Now, you all have my cash flow analysis form, and that'll tell you what kind of leverage that you can put on a property. You're always welcome to bounce any ideas off me, and we're more than happy to. I'm in the Scottsdale office. You're welcome to call the Scottsdale office and make an appointment or just brainstorm with me. I'm around. So I'm trying to be as very conscious of your time. We're coming up on the 25-minute mark. If we have any questions at all. So no questions today. So listen, this is the very best. This is Michael Douville, and I'm wishing you the very, very best. Bye-bye now.